Hi everybody, let's continue. In the last video, we examined firstly how to speculate on the spot and forward market. In this video, we'll learn how to speculate with options. We will analyze the benefit and cost of call option and put option with an example. In this video, we'll analyze the situation to buy or sell a call option firstly. If Hans were to speculate in the option market, he can take 4 strategies by using different types of option. His viewpoint would determine what type of option to buy or sell. He can take the strategy to buy a call option or to sell a call option, or to buy a put option, or to sell a put option. The question is that, under what projection the above different strategies should be taken. If Hans projected a currency will appreciate, that's to say, he expected the currency's future spot rate will be higher than the strike price of the option, then he would buy a call option of the currency. If his projection was correct, the currency would appreciate at the maturity, so he would execute the call option. Afterwards, he would sell the currency at a higher spot rate. Suppose the information of the call option is given, including strike price and premium. The spot rate given is for the spot rate at the time when the call option is matured. Then, the speculation profit from buying a call option can be calculated with the following formula. Profit equals to spot rate minus the sum of strike price and premium. In the example, that is $0.595 per Swiss franc minus the sum of $0.585 per Swiss franc and $0.005 per Swiss franc equals $0.005 per Swiss franc. Here we use the spot rate at the maturity or the spot rate when the option was executed to calculate the profit. Hans could also wait to say if the Swiss franc appreciates more, that's the value to the holder of the call option. Limited loss, unlimited upside. Now a question. How to calculate buyer's break-even price of a call option? Hans' break-even price can be calculated by combining the premium cost of $0.05 per Swiss franc with the cost of exercising the option, $0.585 per Swiss franc. This matched the proceeds from exercising the option at a price of $0.59 per Swiss franc. The exhibit shows the strike price, break-even price, and the different profit situation the call option will bring to the buyer when the market rates are in different areas. When the spot rate equals to the strike price, the option is at the money. When the spot rate is higher than the strike price, the option is in the money. When the spot rate is lower than the strike price, the option is out of the money. However, Hans' only loss will be limited to the cost of the option, or the premium, that is $0.005 per Swiss franc. In theory, the spot rate can be infinitely great, so the profit of the buyer is unlimited in theory. If Hans projected a currency would depreciate, then he could write and sell a call option of the currency. If his projection was correct, and the currency depreciated below the strike price at the maturity, So the holder of the option would not execute the call option. So hence, as the writer of the call option would earn the whole premium of the option. If the currency appreciates a little bit higher than the strike price, then after the holder executes the option, the writer still could earn part of the premium. The profit hence earned can be calculated with the following formula. Profit equals to premium minus inside the bracket spot rate minus strike price. In the example, it is $0.05 per Swiss franc minus inside the bracket $0.595 per Swiss franc minus $0.585 per Swiss franc equals negative $0.005 per Swiss franc. We can say from the formula, only when the gap between spot rate and the strike price is smaller than the premium, that hence the writer can earn a positive profit. To calculate the seller's break-even price of call option is to calculate the spot rate when profit equals 0 in the above formula. So we'll get the formula for seller's break-even price of call option. It equals to premium plus strike price equals to 0.005 plus 0.585 equals 0.590. Compared to the formulas for buyers and the seller's break-even price of call option, we can see that the break-even price of call option for the buyer and the seller are the same, equals to premium plus strike price. This exhibit shows the net profit of the sellers of a call option. Please recall the exhibit of the net profit of the buyer of a call option. We can see the buyers and sellers' net profit line are symmetrical to each other. For the buyer of the call option, the loss is limited, but the profit can be infinite in theory. So for the seller of call option, the profit is limited, but the loss can be infinite in theory. In the video, we learned how to speculate in the option market and analyze the payoff of the buyer and seller of option respectively. Thanks for your attention.